Okay, good afternoon, everyone. So today we are going to solve one additional question from installment method. So this is quite difficult, so I decided to explain another questions from this topic. So you know that if we want to solve this method, then we should remember three assumptions. So when we are going to solve this kind of installment method, we must remember three important assumptions, because we have to prepare the safe payment schedule. So whenever we are going to prepare this kind of safe payment schedule, we must remember these three assumptions. So the first one, you can say that loan from partners are added to their capital balances. So I told you that, for example, we have a loan from our partner Y. So we have a loan from our partner Y. So this loan is our liability, right? We are liable to pay this money. We are liable to pay this money. For example, loan from partner Y is something like $10,000. And at the same time, we find that Y has a capital deficiency balance. Like $15,000. So we have a loan from Y. This is our liability. But we find that partners Y has a capital deficiency balance. If you have this kind of situation, then we are going to offset loan and capital deficiency. We have to offset loan and capital deficiency. So in this situation, we are not going to pay this $10,000, because we said that as we are liable to pay this money, but you already have a capital deficiency, right? You already have a capital deficiency, so we are not going to pay you this loan. So this is the assumption we have to remember. Then another assumption, that the remaining non-cash assets are sold at zero. So if we have any remaining non-cash asset, we are going to assume that they are zero. That means we are going to sell our asset and we will receive only zero amount from the market. So if you receive zero amount from the market, it means that you are having a completely loss, right? You are having a completely loss. So this kind of completely loss, we are going to consider. So if we have this kind of losses, we are allocating these losses. We are allocating these losses to the first partner's capital balances, right? So whenever we have losses, we are going to allocate these losses to the partner's capital balances. And another important assumptions are here, that partners are personally insolvent. Partners are personally insolvent. What is the meaning? Meaning is here, partners personal assets are lower than personal liability. This is very, very important. So if person's personal assets are lower and personal liabilities are higher, it means that he or she is completely insolvent. So this is the assumption. This is the assumption that he or she is completely insolvent. What is the meaning? Meaning means if any capital deficiency, they are not able to bring their personal asset. For example, you have capital deficiency here. For example, this is the capital deficiency, $15,000. If this is the situation, we assume that you do not have any personal cash, okay, that you can bring to the business to offset this kind of capital deficiency. So these three assumptions are important whenever we are going to prepare a safe payment. Okay, so this is, try to understand, this is something just assumption. Okay, it may not be happen, but whenever we are going to prepare a safe payment schedule, we have to keep these 3 points in our mind because this is the most conservative method. So as this is a conservative method, we have to keep always the negative point in our mind. So these three are the negative issues that should keep in our mind. Now let's solve a question. So today I am going to show you the schedule as well as some selected journal entries. Because last time when I discussed the installment method, I didn't show you any journal entries, but today I'm going to show you some journal entries. So read this question that Muskan, Shimra, and Ruham are the three partners who shares profit and losses based on this ratio. So this is their profit sharing ratio, and all partners mutually agree that their association should be dissolved. So they decided mutually that they are going to close their partnership business. And all the balances before the liquidation are as follows. So here we can see that first we can compare these two amounts. First we have to compare these two amounts. So how much cash we have? We have $10,000 cash and we have $18,000 liabilities. So it means that we do not have enough cash to pay our liability. This is important point you have to remember. And another important point is our non-cash asset is $130,000. And these are the capital balances. Now, can you remember what is the difference between installment method and the simple method? So in the simple method, we do not consider this kind of points, right? Assumptions. And in the simple method, we sell all of our non-cash asset very fast, right? Just we immediately sell our asset, right? We are decided not to continue, just we make a faster sell. Last class, I told you that it's something like fire sell, right? Just we are going to sell all the assets in one time. But installment method said that to sell all of our asset is unrealistic. So the most realistic issue is we can sell our assets based on some installment. So we are going to sell our assets, okay, over time. That means not in one day. We are going to sell assets time to time. So it is called installment. So that's why the installment method came, right? We are going to sell our assets through installment. Now you can see that our non-cash asset book value is $130,000. So if we add this money here, so book value here equal $130,000. This is the book value, and this column is the fair market value. This column is the fair market value, right? And fair market value means cash received from market. We received cash from market. So we sell our book value, right? We sell our book value. That means I can write here. We sell our book value. And we receive cash from the market, right? We receive cash from the market. Now we have 4 sales here, and you can see that when we make first sell, so our book value is $43,000, but sales price $38,000. So it is a bad news for us. So we have $5,000 loss. We have $5,000 loss here. And when we make second installment, then we find that we have another loss here, and it is $20,000. $20,000 loss. What about the third installment? We have $10,000 gain, right? Within bracket, it is loss because I mentioned here. And last sales, we have $25,000 loss. So we find that we have sometimes we have loss, sometimes we have gain, again we have loss. So these are the schedule when we are going to sell our asset, book value, and the cash received from the market. Now, this is important because partners are looking for cash. Partners said that they prefer to receive cash as soon as it is available. So after paying liability, first, this is according to the partnership law, we must pay our liability first. After paying the liabilities, whenever we are going to sell our asset, we have some cash, right? Whenever we sell our asset, we have some cash. So whenever we have some available cash, it should be distributed to the partners as soon as possible. So very simple, you are going to close your business, you need to money back, right? But you are not going to sell your asset at a time. According to simple method, you sell your asset only one time, right? And you sit together and you receive your cash back. But here, assets are going to sell over time. So partners request the business that whenever you sell your asset, okay, that means whenever you sell our asset, whenever we have available cash, please give us money back. That means every installment, we have to return back some cash to the partners. Now the problem is, look at here. Maybe we don't have enough money to pay the partners. We may not have enough money. For example, we have $1,000. For example, we have $1,000 cash, but here our capital are higher. So we cannot pay the money to all people. So we have to pay money to those people who has the ability to survive. So whenever, look at here, whenever cash is going to be distributed, we have to make a safe plan. That means all partners may not receive the money. Only the partners who has the surviving ability, he or she will receive the money. Okay, so we have to make schedule to see who has the ability to survive. Now requirement 1 said that prepare summary column of partnership liquidation. We are going to prepare one columnar. That means we have several column here about the realization of liquidation. And you should prepare supporting a schedule of safe payment. So we don't know how many safe payment we need. Whenever we solve our question step by step, at that time we can realize how many safe payment schedule we need. From the very beginning, it cannot say that we have 3 schedule or we have 4 schedule or we have 2 schedule. We don't know. So we have to prepare a schedule, okay, based on the question pattern. And whenever we will have a safe payment, we have to provide cash to the partners. Anyway, so we can solve this question first. So according to this question, now our cash 10,000, non-cash 130s. This is the liabilities and this is the partners capital. So we put this information here. These are the balances. And if I prepare a question from here, I will give you up to here only. All other part you have to solve by yourself. Okay. So now you can see that first we have to pay our liability. Now, if we want to pay our liability, we don't have enough cash to pay the liability. We don't have enough cash to pay the liability. So what should we do? We have to sell some of our asset, right? We have to sell some of our asset to pay the liabilities. So we are going to do this first. Sell non-cash assets. So how much non-cash asset we sell from this question? We sell $42,000 of non-cash asset. This is the asset we are going to sell. And from market, we are going to receive $38,000. We're going to receive $38,000 from market and we sell our asset. Now we find that this schedule, this installment, we have a loss. And the loss is going to be distributed to the partner's capital based on 40, 40, and 20. And loss is a bad news. Why loss is a bad news? Because loss decreases their capital. You have to absorb the loss. When you absorb your loss, your capital is going to decrease. Okay, so $5,000 we are going to distribute 2,000. 2,000 and 1,000. So we sell our non-cash asset, we receive cash, and we allocate the loss, right? So after doing so, now we have $48,000 cash, right? We have $87,000 non-cash. Now we have $18,000 liability, and now we have $43,000, $25,000, and $49,000. Yes. Now first I am going to show you the journal entries for this part. Journal entries for this part. We sell our non-cash asset and we allocate gain or losses. Okay, so let me show it. So I copy it so that you can understand. So this is the column we are going to row. We are going to show the journal entries. So you have to follow the journal entries recording system properly in the exam question. Okay, don't lose your grade. Date, then accounts title. Then we have so this is several column for the journal entries. So you don't need to put anything in the date and reference. You can put the number. If I ask you some number, you can put date in as a number. So now here you can see that we sell our non-cash asset and we receive cash. So we receive cash debit. So we receive cash $38,000 cash debit. And we sell $43,000 of non-cash asset. So you can see that I keep some space, right, for the credit item. Non-cash assets credit. So credit is $43,000, $43,000. Something like this. Now we see that debit and credit is not equal, but we know that in the double entry system, we should make debit and credit equal, right? So we find that debit side is lower $5,000. Debit side is lower $5,000. So if we put $5,000 in the debit side, then debit and credit equal. So what is the name of this $5,000? We know that this is the loss. This is the loss. Now you have to write the narration, something like to record sale of non-cash assets. To record sale of non-cash asset, we write here. So this is the narration. Now after this is the sale of non-cash assets, and we have a loss. We are going to allocate this loss to the partner's capital. So now loss, look at a loss is debit. Now we are going to record loss. We are going to record loss in the credit. So loss debit, and now we record loss credit. We are going to close loss. Loss is to be going to closed, right? Loss should be closed. You can see that loss we record debit side, loss we record debit side. Now we record loss in the credit side. Okay, so it is closed, and this loss is going to be absorbed by Muskan, Simra, and Ruhama. So their capital is going to decrease, right? So you know that if capital increase, it is credit, and if capital decrease, it is debit. So now, for example, M capital debit, then S capital debit, and R capital debit, and the amount is this one, 2,000, 2,000, and 1,000. And we write a note here, narration. We allocate loss to the partner's capital, right? So this is the journal entry for here. So we have now cash $48,000, and now our liabilities is $18,000. That means we have now enough cash. We have now enough cash to pay the liabilities. Now payment to creditors. So we are going to pay $80,000 to the creditors. Our cash decrease. Cash decrease $18,000, and our liabilities decrease $18,000. Right? After paying our liabilities, how much cash we have now? $30,000, right? $30,000, and we have remaining non-cash asset. This is the case. This is 0. Yes. Now I'm going to show journal entries for this one. Payment to liabilities. So we pay cash credit $18,000. And we are going to close our liabilities. Liabilities debit $18,000. Record payment to creditors. This is the journal to pay the liabilities. So we don't have any other liabilities. So liabilities closed. Liabilities closed. Now partners said that, that this is the partners requirement. Partners said that partners prefer that cash to be distributed as soon as it is available. Whenever you have cash in the business, we should pay this cash to the partners. Now, after paying the liabilities, $30,000 are the cash available, right? $30,000 cash available. So this cash is going to be distributed to the partners. Now the problem here is cash is $30,000, but partners' capitals are higher than the $30,000. So as this is the case, we have to prepare a safe schedule payment. This one, we have to prepare safe schedule payment, a safe payment schedule to see who is the partner going to receive this $30,000. Maybe they are not going to receive, right? All partners are not going to receive this money because it is only $30,000. So we are going to see that who has the surviving ability and who do not have. So to prepare this kind of schedule, we refer back to our assumption again. So here, in this question, we don't have this part, right? In this question, we don't have any offset loan. But in this question, we have these two requirements. One is the remaining non-cash assets are sold. This is the assumption. The remaining non-cash assets are assumed to be sold $0. Okay, so which one is the remaining non-cash asset? This is the remaining non-cash asset, right? $87,000 is the remaining non-cash asset. We assume that we are going to sell it with $0. If we sell it and receive $0, okay, if you sell it and if we receive $0, it means that it is completely lost, right? It is completely lost. So we are going to consider this kind of loss to see. So we are going to consider this loss to see who has the surviving ability. We are going to see this now. Prepare the schedule 1. So according to schedule 1, so we have to write here capital balances before safe payment. So what is the capital balances before safe payment? We just copy from here. This is the capital balances before safe payment. Now we have to consider that this is our potential loss. Okay, this is our potential loss. So allocate potential loss, and it is $87,000. This is the potential loss, and we are going to share this 4, 4, and 2. Right? We are going to share this loss like this way. So Muskan is going to share the loss 34,800. Also, this is 34,800. And here 17,400. So after absorbing this potential loss, look, this is potential, not the actual loss. We just assumed it. So their balance is now 8,200. then 9,800 and 31,600. Right? This is the capital balances after absorbing potential loss. Now we find that this is the owner or partner have the capital deficiency, right? Capital deficiency. So now again we have to go back this assumption, the last one. So if you have any capital deficiency, you don't have the ability to bring your personal cash because we assume that you are completely insolvent. Okay, you are completely insolvent, you don't have the ability to bring cash. So we are going to, as these people cannot bring any cash, right? If these people cannot bring any cash, so other two partners, Muskan and Ruhama, is going to share their capital. Okay, going to share their capital with Shimra to absorb this kind of capital deficiency. Do you understand? So, for example, I have capital deficiency. So you give me some capital, other people give me some capital to make me zero. Because I'm not going to pay any money, right? I'm not going to pay any money. So you give me some of your capital to make me zero. So you give me 9,800. You give me 9,800. That means Muskan shares some capital from here and Ruhama shares some capital from here. And they are going to share 40% and 20%. Do you understand? So total capital deficiency is 9,800. So Muskan will share 40% and Ruhama will share 20%. So you can say here that allocate deficiency. We are going to allocate deficiency. So what is the amount of deficiency? 9,800 is the deficiency, and we are going to allocate 4:2. And it is something like 6,533 and 3,267. Okay, so we give her some capital and we absorb this kind of loss. Now, what is the balance after that? After that, the balance is 1,667 and 28,333. So this part is called the saved payment. This part is called the saved payment because how much saved payment we have actually? We have $30,000 available. We have $30,000 available, right? And this $30,000 business is going to pay 1,667 to Muskan and 28,333 to Ruhama. Shimra is not going to receive any money, right? So this $30,000 is not going to pay based on this ratio. Try to understand. This $30,000 is paid based on a saved payment schedule. Now we are going to pay this money to the partners. So again, whenever cash is available, we are going to pay it to the partners. So these partners are going to receive this money. And cash is going to decrease. So look here, we pay cash to the partners, so our cash decrease. Our cash decrease, and you know that if you receive cash from business, your capital is going to decrease, right? Your capital is not going to increase because this payment means it is the distribution of your capital. So your capital is going to decrease because you receive this money. You receive this money from your capital balances. So this is called payment Payment to partners based on Schedule 1. This is the payment of partners based on Schedule 1. Now I am going to show you the journal entries for one schedule. Okay, because if you understand the journal entry for Schedule 1, Schedule 2, Schedule 3, you can easily solve it. So I no need to show you this kind of journal entries. So actually my title is here selected journal entries. So I am not going to show you all journal entries. Selected journal entries. That means I am not going to repeat some journal entries again and again. So what should be the journal entry for Schedule 1? Let me see. Let me explain to you. So these two items journal I'm going to show you. Allocate of deficiency and make the safe payment. Okay, make the safe payment. Now look at this point. Allocate of deficiency. Here, Shimra is going to receive capital, right? From whom? From Muskan and the Ruhama. That means Muskan is going to sacrifice this capital, right? So if you sacrifice your capital is decreasing. And when your capital decreases, it is debit, right? Then Ruhama is going to sacrifice her capital is going to decrease debit, but Shimra is going to receive the capital. So the journal here is M capital debit because it is decreasing. M capital decrease, then R capital decreased, right? However, S capital increase. S capital increase. So nothing is related with cash. Try to understand. Nothing is related with cash, right? Because I'm not going to give you my cash to your capital. I am going to give my capital to you. So that's why my capital will decrease and your capital will increase. Something like this. So Muskan is going to sacrifice this amount. R is going to sacrifice this amount. And S capital increase $98,000. So this is the journal entry for Schedule 1. Okay. Then in the exam question, I can also ask you prepare journal entries for Schedule 1. So what is the narration here? To allocate capital deficiency. To allocate capital deficiency. Now, after allocating capital deficiency, we are going to pay $30,000 cash, right? We are going to pay $30,000 because this is the safe payment. We are going to pay $30,000 cash. Muskan will receive this money, right? And Ruhama will receive this money. So, and I also told you that whenever you receive money, that means if I copy this one also. So if I copy this one also, that means look at here, I am going to pay cash $30,000. That means business is going to pay cash $30,000 and they receive this money, right? It means that their capital is decreasing. So again, these two people receive cash. These two people receive cash means their capital is going to decrease. their capital is going to decrease how much? This is the capital they are going to decrease because they receive the cash. And business pay cash. Business pay cash $30,000. Business cash decrease $30,000. So the narration is to record save payment. Any question? Then after paying this cash, we have zero cash now. We have $87,000 non-cash. We don't have any liabilities. Now, what is the capital balances for Muskan? It is 41,333. Here is $25,000 capital balance remaining. And here is 2667. 2667 is the remaining balances, right? Now we are going to sell asset again. We are going to sell asset again. We are going to sell $37,000 of our asset. Okay, $37,000 asset we are going to sell. And after selling, we receive cash $17,000. We receive cash $17,000. So bad news, right? $20,000 loss. So this loss, look, this loss is going to absorb by different people, different partners. This loss is going to absorb by the different partners. So 8,000, 8,000, and 4,000. So I'm not going to show you this journal entry. Why? Because I already show you this journal entry: sell non-cash assets and allocate loss. So this journal entry I already explained, right? This journal entry I already explained. So we are not going to show you again. So sell non-cash asset here, the same. Sell non-cash asset and we allocate the loss, right? Now after allocating the loss, what is the balance? Our cash is now $17,000. And what is the balance of our asset? It is $50,000 remaining non-cash asset. We don't have any liability. And what is the balance of Muskan capital? It is $33,333. Then what is the balance of Shimra? It is $17,000. And Ruma's balance is $11,000. 11,000. No. It is 16,667. 16,667. So this is the balances. Now again, you can see that this is the available cash, right? This is the available cash. And according to this question, whenever cash is available, pay them as soon as possible. So as now $17,000 cash available, we are going to pay this money to the partners capital. Again, the problem is we only have $17,000, but partners capitals are higher. Then what should we do? Make a SAFE payment schedule again. Make a SAFE payment schedule again and again. So what is the capital balances before SAFE payment at this moment? This is the capital balances. This is the capital balances before the SAFE payment. Now, what is the potential loss? How much? $50,000 non-cash asset. We assume that we are going to sell it zero price, right? So this is the potential loss. So our potential loss is now $50,000. $50,000. And this potential loss we are going to share 4:2 ratio, right? This ratio. And it is something like 20,000, 20,000, 10,000. Anyway, this should be here. So this is the capital balances and potential loss is now 20,000. 20,000 and the 10,000. So this is the potential loss. After absorbing the loss, the balance is 13,333, then 3,000, and 6,667. Again, Shimra do not have the ability to bring cash from personal account because although she has the capital deficiency, but our assumption is that she is insolvent. If she is insolvent, Muskan and Ruhama is going to share capital with her. Okay, so this $3,000 is the capital deficiency. It is going to allocate to Muskan and Ruhama based on 4:2. So Muskan is going to absorb 2,000 and Ruhama is going to absorb 1,000. Now after that we have SAVE payment. How much SAVE payment we have actually according to this question? $17,000 SAVE payment. So SAVE payment is $17,000. And this SAVE payment is going to allocate to them. So Simra is not going to receive any money because she is still capital deficiency, right? She's not going to receive any money. So Muskan will receive 11,1333, and Rohama will receive 5,667. 5,667. So this is the SAVE payment of $17,000. Now we are going to pay this. We are going to pay this. So whenever we pay this money, you know that they are going to receive this money means their capital is going to decrease. They cannot claim this money again, right? Because you receive cash, you cannot claim this money again. So your capital is going to decrease. And we pay cash $17,000. Our cash decrease. Now, this is the payment to the partners based on Schedule 2. Right? Based on a Schedule 2, this is the payment. Now again, we don't have enough, no cash. Our asset remaining $50,000. Then we don't have any liabilities. Then what is the remaining balance for Muskan? It is $22,000. Then Shimra balance $17,000. And Ruhama's balance is $11,000. So we still have some asset to sell, right? Now question said that we sell $20,000 of our remaining asset. We sell $20,000 of our remaining asset. and we receive $30,000. We receive $30,000. So good news or bad news? Good news. So $10,000 is the good news. $10,000 is going to give it to you, right? So your capital is going to increase. Your capital is going to increase. So gain increase the capital, loss decrease the capital. So 14,000. So 10,000, right? 10,000 is the gain. 10,000 is the gain. So 4,000, 4,000, and 2,000. 4,000 will receive by Muskan, and 2,000. So this is called sell non-cash asset. Sell non-cash asset and allocate gain. Sell non-cash asset and allocate gain. Now I am going to show you journal entries for this, because I already show you journal entries for sell non-cash asset and allocate loss, right? Now I am going to show you sell non-cash asset and allocate gain. What is the journal entry for this? Let's see. The question said that we sell our asset for $30,000. We sell our asset $30,000, but we receive cash. Sorry, we sell our asset $20,000, right? We sell our asset $20,000, but we receive cash $30,000. So debit and credit is not equal. So the difference is $10,000. We put it in the credit side, and this is a good news. This is our gain. This is our gain. This is our gain. Now we are going to close our gain. We are going to close our gain. $10,000 we are going to record in the debit side. So gain closed, right? Gain closed. And gain transfer where? Gain transfer to the capital. Gain transfer to the capital. So 4,000, 4,000, and 2,000. This is the gain transfer to the capital account, right? And we allocate gain. We allocate gain to partners' capital. Clear? We allocate gain. Now we have $30,000 cash. We have $30,000 cash. We have $30,000 asset, right? Remaining. We don't have any liability. And now, what is the balance for Muskan, right? It is $26,000. This is $21,000. Right? And yes, $13,000. Now again, you can say that how much cash we have. We have $30,000 cash we have, and whenever we have available cash, we have to distribute to the partners, right? Now this $30,000 we have to distribute to the partners, but again the problem, this $30,000 is lower, but their partners' capital is higher. Then go for another schedule. Go for another schedule. So we are going to prepare another schedule. We're going to prepare another schedule called schedule 3. Now, what is the balances before the save payment? This is the balances before save payment. And what is the potential loss here? $30,000 is the potential loss, right? $30,000 is the potential loss. $30,000 is the potential loss, and this $30,000 is the potential loss is going to allocate to the partners 6,000. So after allocating this loss, what is the balances? The balance is $14,000 for Muskan, and Shimla is $9,000, and Ruhama is $7,000. Now, who is capital deficiency? No one is capital deficiency, right? Yes, no one is capital deficiency. So our save payment, you can see that our save payment is $30,000, right? According to this question, save payment is $30,000. Yes. So our cash available $30,000, and we are going to keep them this, right? So we are going to pay this money to them. So again, whenever we are going to pay this money to them, their capital is going to decrease because they receive cash, they cannot claim this money again. So their capital, they receive cash and we decrease their capital. We decrease their capital. Now this is based on schedule 3. This is based on schedule 3, and we decrease our cash $30,000. After that, again, we don't have any cash, right? We don't have any cash. We have some asset remaining, non-cash asset we have remaining, $30,000, right? We don't have any liability already paid long time before. Now we have, how much we have? 2,000. Let me see. So 26 and 14, right? 12,000. $12,000 remaining here. Then $12,000 remaining here. And $6,000 remaining here. $6,000 remaining here. So this is the remaining capital, remaining asset. Now again, we have another sell. You can see that we have another sell, $30,000 asset we sell. So we sell $30,000 asset again, right? Asset decrease. So this is the last sell. Look, after last sell, we don't have any other asset remaining, right? That means we don't have any other potential loss. Do you understand? We don't have any other potential loss. And how much cash we receive? We receive cash 5,000. We receive cash 5,000. So 25,000 is the loss, right? 25,000 is the loss. This loss is going to allocate to whom? Allocate the partners. And it is $25,000 loss. So 10,000, 10,000, and 5,000. 10,000, 10,000, and 5,000 loss. 5,000 loss. So again, we sell our non-cash asset. We sell our non-cash asset and we allocate the loss. So again, I am not going to show you the journal entries because I already explained. So what is the balance now? Balance after paying this, balance $5,000. We don't have any other asset. Our liability is 0. Now what is the balance for Muskan? It is $2,000. $2,000. and $1,000. So again, whenever we have available cash, right? Whenever we have available cash, we have to pay it to the partners. So how much cash available we have? $5,000. And how much capital balances they have? Also 5,000, right? So we don't need to prepare any schedule. Again, why we don't need to prepare a schedule? Because we don't have any other asset to cover the potential loss. So now we no need to prepare any schedule because we already prepared 3 schedules, schedule 1 to 3. Now we are going to pay cash to the partners. Do you understand? Okay, as we have time, let me discuss question 2. So Charlie, Jack, and Goodbird have a business and they are no longer profitable. They have tried to sell their business intact, but have no buyers. They don't have any buyers. The partners' capital balance sheet as below. Do you understand? So their business is no longer profitable. So they decided to sell their business as it is. But at this moment, there is no partners. No buyers who can buy their asset. Now, according to this question, they has cash. $30,000, and their liability is $20,000. Good news, right? So they have enough cash to pay the liabilities. And the other asset is $90,000, and total is 120. And this is the 3 partners, C, J, and G capital, and this is their total capital and liabilities. Now, C, J, and G share income and losses. This is their income and loss ratio, right? This is their income and loss ratio. And during January 2023, 15,000 of other assets were sold for $10,000. Look, you sell $15,000 of your asset. So this is the book value. This is the book value. And this is the fair market value. And you receive cash related with cash. Related with cash. The creditors were already paid. So we no need to think about this issue. Creditors were already paid. Why? Because they have enough cash. Creditors are already paid, and the remaining cash was distributed to the partners. Okay. So after paying liability, remaining cash was already distributed to the partners. So we no need to think about these 2 issues. So liabilities are paid. After paying liabilities, remaining cash goes to the partners account anyway. Prepare a safe schedule payment and determine the cash distribution. So this question just only talk about to prepare the safe schedule plan, not the whole schedule for the payment. That means just we are going to prepare a schedule. Now we can see that we can write the capital balances first. So how to solve this kind of safe payment? Capital balances. Capital balances of the first day. Sorry. This is the capital balances is given. $25,000. Then $35,000. And $40,000. Capital balances are given. Now you can see that our book value is $15,000, but we received cash $10,000. That means that how much loss? $5,000, right? $5,000 loss. And we know that this loss is going to absorbed by the partners. So loss on asset sale, $5,000. And this $5,000 they are going to distribute this. Going to distribute this way. And it is 1,000, 2,500. And 1,500. And 1,500. Right? So what is the balance now? The balance is now $24,000. Then 32,500. And 38,500. Right. Now you know that we have another potential loss. Can you remember how much, as we are making the safe payment plan, right? We have to consider our potential future loss, right? Potential. So we already sell $15,000 of our asset from $90,000 of asset. So $90,000 is our non-cash asset. We sell 15,000 from them. So remaining $75,000, we are going to assume that this is our potential loss, right? And we allocate this potential loss among the partners' capital. So allocate. Now allocate loss. And the potential loss here is $75,000. Do you understand how $75,000 came? Total is $90,000. And we sell $15,000 from here, right? We remaining have $75,000. And this loss again, this loss we are going to absorb by this. So again, I can write here so that you can remember. It is $90,000 minus $15,000 equals $75,000. So this loss is going to be absorbed by 253. So something like 15,000. $37,500. 37,500 and 22,500. 22,500. So this is the loss absorbed by them. After that, they have $9,000 capital. Capital deficiency is 5,000 and 16,000 for G capital. Again, can you remember this is assumption 2, right? Potential loss. Do you have another assumption? Can you remember? That if there is any capital deficiency, they don't have the ability to bring their personal asset. They are insolvent. So this $5,000 is going to share, okay, by C and G based on 2 and 3, right? Based on 2 and 3. So allocate J's capital deficiency. And what is the capital deficiency here? We see that it is $5,000. $5,000 is the capital deficiency. And it is going to share by C. C ratio is 2, right? C ratio is 2, and by G. G's ratio is 3. 2 and 3. Clear? So he is going to receive 5,000 capital, not 5,000 cash. Okay, he is going to receive 5,000 capital from them. So 2,000 from C. C sacrificed 2,000, and remaining 3,000 sacrificed by G. After that, they have $7,000. $7,000 is not going to receive any money, and it is $13,000. Now, can you tell me it is safe payment or not? Is it safe payment? That means how much cash remaining? Can you understand from the question? How much cash actually remaining for this safe payment? Try to think. First, our cash is, so I can show you here. Cash, right? First, we have $30,000, right? We have $30,000 cash. From here, we pay liability $20,000, right? We pay our liability $20,000. Do you understand? Then we sell $15,000 of asset, right? We sell $15,000 of asset and receive cash. How much? $10,000, right? $10,000. So this is the actually story about the cash, right? This is the actual story about the cash. Our balance $30,000. We pay liability and we receive cash $10,000 from selling our non-cash asset, right? So what is the balance now? $20,000, right? So balance is $20,000. So this is the payment available to make at this moment. So, and J is not going to receive any cash. Why? Insolvent, right? And C, observing the capital deficiency, need 7,000, and G need 13,000. So our safe payment also 20,000, right? Our safe payment is also 20,000. So safe payment 20,000, we are going to pay this like this. So this money we are going to pay them. Something like this. Safe payment. So that's all about chapter liquidation. Okay.